The Share Pickers Podcast with Justin Waite.
Monday, 26th of June, 2023. I'm recording this. It's 21:34. Thought it'd be accurate there. But the reason why I'm recording this is it's an historic day. The AIM All Share is at a new low, everyone. Well done, AIM All Share. Well done. It's now at 760 points, that is. And, of course, the previous low was in October last year. It's 775, so it's blown past that. And it's now down 42% from its all-time high, which was 658 days ago. Now, the level we're at now, the last time it visited this level was during the Dash for Cash crash in April 2020. And I don't know if you remember that, but that was when the whole world was shutting down due to the pandemic. There's lockdown happening and everyone started panicking. And it's one of the fastest sell-offs ever and one of the fastest rebounds ever. So that dip, where it went down to below 760, whatever, that didn't last very long. And it bounced back very quickly. Now, previous to that dip, it was last at this level on the 4th of August, 2016. So if you ignore the pandemic, it's literally 6 years ago, pretty much, or 2,505 days ago, we were last at this level. And it's hard, you know. The market's been very hard. Like I said now, from the high, 658 days ago, it's been dragging down, grinding lower and lower. And mentally, it's very challenging. You know, you see your portfolio go down, and it's hard. You know, you feel like you're losing money. We know, bear markets don't last forever. Average is around about sort of 18 months to 2 years. We're sort of towards the 2-year area now. But what's annoying for me is when I watch like CNBC at night and you see the S&P 500 or the Nasdaq, Nasdaq is 29% off its low, which is technically a bull market. Now, I don't think it's going to go well for them because, valuations are very stretched. And it's largely down to this because the Magnificent Seven, as they're now being called, the big stocks, that AI and Microsoft, Apple, all these are rallying very strongly, NVIDIA, and it's distorting the indices because 50% of the S&P 500, which is 500 companies, 50% is made up by these 7 companies. So if they do well, pretty much the whole index is well. But you strip all that out, and they're not doing well, pretty much flat. If you look at the Russell 2000 index, that's down. It's going flatlining. And I believe they will roll over. And I think, I've been teetering around having between 30 and 60% cash for the last 2-3 months now. And I've got to be disciplined. Not just try and jump in there just for a trade here and there. I do now and again, not for a trade, I see it as an investment, but I'm very careful that the bottom of this market could fall a bit further, I think, and we could go down further. So I'm very careful about if I don't get it right, the momentum of the stock. If I look at the company fundamentally and the momentum isn't there, I'm prepared to cut and run, if it goes below certain support levels. But there's things I'm worried about, and that's the inversion of the yield curve. Now, just to roughly explain what that is, if you haven't heard of that, well, you probably have, but it's quite technical. But essentially, it's government bonds. They issue, bonds, and each of these bonds have a duration. So you can get a 2-year bond, a 5-year bond, a 10-year bond, a 30-year bond, whichever bond you invest into, whichever government duration of the bond. The longer the duration, basically, the more interest the government will pay you. That's the way it should be. So, for example, you should get like the 2-year bond paying a percentage yield on a yearly basis, say around about, say, 2%. And then a 10-year should pay more than that, say 2.5%. And then 30-year, even more than that. At the moment, that isn't happening. So if you look at the yield from that, from say, a 2-year bond will be 2%. And then it goes up from the bottom left to top right, you get like 2.5% for 10-year. That isn't happening at the moment. You've got like let me just check what they are actually. Check the yields on these. Scroll down. So you've got, we've got the government 2-year in America. It's paying 4.74%. All right. And the 10-year, it's 3.7%, almost 1 percentage point below, 100 basis points below, that's called the inversion, because that's sloping down from top left to bottom right, rather than the other way around. Now, why does this happen? Well, people say that people are buying longer-term bonds because they think something's going to happen in the shorter term. The government may be sort of having to reduce interest rates very soon, so they sell off. And it's an inverted. The relationship between the price and, of course, the yield is inverted. So if a price of a bond goes up, then the yield goes down. Now, what's happening with 2-year is it's been sold off and the yield is going up. So when that happens, and it doesn't happen very often, an inverted yield curve, so you plot the two yields against each other. When that happens, it's a very good predictor of a recession. How good? Well, it's predicted accurately the last 10 recessions. Whenever the yield curve is inverted, the last 10 recessions. So I'm very cautious because I think if you're a betting man, or I suppose if you're an investor, you sort of are to a certain extent because everything's about probability. I would say we're going to have a recession. Nothing officially has been announced. And not only that, what I'm also worried about is that the last major, and I wasn't as invested or, as in the game as much as I was this time around, the last sort of major recession I was involved in, now ignore the, the pandemic recession, because that really was a technical one, because everything shut down, so people couldn't trade. Then it opened back up, the economy, so it rebounded. And there was stimulus support from the government. So the last big recession I was involved in was obviously the Great Financial Crash in 2008, 2009. And that, to a certain extent, it did last 2 years, but the rebound was very quick. And that's largely because, government stimulus, government backed the banks, and so they could sort of fix the problem quite quickly. Now, with inflation, the governments can't fix the problem very quickly. All they can do is hike up interest rates and maybe do some quantitative tightening. But it's a very, blunt, indirect way of doing it, dealing with it. And the lag factor is unknown. It's the same with the lag factor of quantitative easing, with inflation. That was unknown. So I'm a little bit concerned about the inversion. And I'm also a little bit concerned that the recovery will not be as fast as it was in the Great Financial Crash. So my, strategy at the moment is sit and wait. And I think there's certain stocks out there that will do very well, and that they've taken a hammering, certain bigger stocks. So you don't have to take a risk on smaller stocks, even though I do have a majority of smaller stocks. But there's some big stocks I'm waiting on where they are proven businesses, very successful businesses that have been hammered. And so I think that I see those as less risky, and you could probably go, expose yourself more to a company like that. But it's not going to happen yet. Essentially, it's a sit-and-wait game for me. And it is hard work. But it's a bit like being caught in a riptide. I don't know what a riptide is. Basically, where, when you have waves coming into the beach, that's what normally happens. But you have this a swirl where sometimes too, different parts of the beach are swirling around. In the middle there, you've almost want to say no waves because the waves are going out. And it will drag you out. Now, there's no one swimming against the riptide. Because people drown like that. They get tired out and they're just going nowhere. They're just getting sucked out. They keep fighting it. And all of a sudden they get drowned because they get exhausted. And the only way to do it is keep afloat. And you go out and hopefully you can swim almost parallel to the beach and you catch the normal tide and come back in. That's where we're at the moment, I believe. I think we're in a bit of a riptide situation with the market. And until it changes direction, and we will know when it changes direction, you'll see a big up day, and then another big up day, across the market, broad rally. I think that's the time to really go in on a company that you've researched, because right now, you've got lots of time to research companies. That's what I'm doing. I've literally got a list of about 10 companies that one of those, or two, or maybe three of those, I'll probably go big on, because I do believe they'll do very well. I just think we're in an economic space now. It's not good for them in those companies, but they will change. That economic, riptide will change. But looking on the positives, it's a horrible market. It's been for a long time. It's emotionally wearing. But in bear markets, you have a choice: get better or give up. And I've almost a couple of times want to knock it on the head and say, oh, this is too much hard work. But it will get better. The markets will get better. And so, if you can, if you're not exasperated, which I am on a daily basis, motivation is dwindling, really is. But you got a choice, get better or give up. I say to my kids all the time, winners don't quit, quitters don't win. I've felt like quitting quite a few times. But if you choose to get better, you will earn a lot more when the bull market returns. But I would say, try not to teeter around on the edge at the moment, in stocks too much. Because like I said, the current's against us. It really is. And it's almost, a waste of time. It's futile. That's what the word is. It's futile, sort of paddling frantically, trying to make money when the tide is against you. And what's got to bide your time is everything goes in waves. Sound goes in waves. The market goes in waves and cycles. It's almost like waiting for the tide to come in, the tide to be right. There's no point putting your board in the water and really going for it when you're not going to catch a decent wave. And you may be lucky. I've had quite a few good returns, but there are waves, and they tend to happen, even the bigger waves. But within that, the smaller waves, there's 3 months or so where you get down markets, then go back up. And I think one of those will be the big one, but it may not be. So be careful. But hang on in there, because you know what? Bear markets like this don't come around, every year or every 2 years. Normally they are 5 to 10 years. And so you're looking at once, almost in a 10-year cycle here, where there'll be an excellent opportunity to make money, but don't go too early. There's plenty of time.
The Share Pickers Podcast with Justin Waite.